Welcome to TCorp's podcast, Beyond the Noise. I'm Emily Perry, Head of Macroeconomic Strategy at TCorp. In this episode of Beyond the Noise, I recently had the pleasure to talk to two wonderful guests to share their insights into the world of bond markets. While equity markets tend to get more attention, and bond markets always seem just a little bit mysterious, they are an important way that governments, banks and corporates raise funding. And of course, bond markets make up an important part of investment portfolios. We hope that this episode gives TCorp clients a high-level insight into some of the important developments that are shaping global bond markets. The first guest to join me on this episode was Rachael Boyte. Rachael is a portfolio manager on the Australian fixed income funds at PIMCO, with a specialised focus on the Australian and New Zealand macroeconomic environment. And PIMCO is one of the largest investment managers in the world, managing more than $2 trillion in assets and has a focus on fixed income. The second guest was Daniel Chandler. Daniel is the Head of Funding and Investor Relations at TCorp. He is responsible for TCorp's funding program, raising debt in the bond market on behalf of the New South Wales Government and its agencies. Daniel has spent over 20 years in financial markets with a focus on debt capital markets and has worked at large banks in Australia and offshore. Here's my conversation with Daniel and Rachael. Thank you, Rachael, for joining us today.
Thank you for having me.
And thanks to you, Dan, as well, for being here.
Thanks, Emily.
So let's jump straight into the meaty issues. It really is impossible to talk about financial markets right now without touching on geopolitics. So Rachael, we're in the middle of quite a big shock, quite a big conflict in the Middle East, and people are saying now that the RBA has to hike rates today because of that. Are you more worried from your perspective about a rise in energy prices causing higher inflation, or are you more concerned about energy shortages causing a sharp slowdown in economic growth?
Yeah, it's a great question. I think from my perspective, markets have moved very quickly to reprice the inflation side of the story. So since the start of the geopolitical uncertainty, we've seen a big repricing in bond yields, an expectation that the RBA will have to hike more times to combat inflation and that they will have to bring those hikes forward. I am a little bit more worried about the demand destruction piece, which I don't think markets have moved to price yet. We're already seeing fuel rationing in parts of Asia because they just can't get the resources to the right place at the right time. And it's if you don't have it, you don't have it. And so that hits the demand side of the equation very quickly. So I think that's what the market's not looking at yet. That will come through to growth. The RBA will have to weigh that up, and I think that they have been talking about that already, the uncertainty of how they can balance inflation with a household sector that's already a bit weaker than they expected. What we saw in the last quarter of GDP was household consumption is already tracking below the RBA's forecast, and that's only going to get worse with this fuel price shock.
So how long do you think it'll take before the concerns start shifting to growth rather than inflation?
I think it could happen quite soon, given that we are already seeing signs of it in parts of Asia, Southeast Asia in particular. As soon as people can't get the fuel that they need, I think that people start to cut back on the demand side of things. And where I think it's different from 2022, that's a comparison that a lot of people are making at the moment. In 2022, we had basically runaway inflation, headline inflation got up above 7.5%. Is coming out of the pandemic, it was both the supply side and the demand side working together. So we had a supply shock because of Ukraine, but we also had a lot of pent-up demand because people had been stuck at home for a couple of years and they wanted to get out and spend again. I think that this time around is quite different in that we've only got the supply shock. We won't have the demand side of the equation working against inflation as well because people have already run down savings a lot.
Yeah, I think that is interesting. I think timing, like you say, matters. Central banks in the past have looked through these type of supply shocks, but now we've had a sort of a sequence of shocks and maybe it is getting harder to look through at the moment. But, this raises a question more broadly. We have seen this series of shocks and, the world is definitely becoming more kind of separated and conflicted. How do you kind of think about, as a bond market investor, these kind of geopolitical conflicts? How do they play into your investment decisions or how you manage your bond portfolio?
Yeah, I think the most important thing for us is making sure that liquidity is there and prioritising liquidity. Some of our clients during a crisis period will need to take money out to fund other areas of their portfolio. And so you don't want to give your liquidity away too cheaply, because keeping some dry powder, it also allows you to invest when things get really stretched. So for us, we're always kind of prioritising that liquidity and making sure that when we are spending our cash and when we are taking risk, that we're getting compensated appropriately. So we're constantly scrubbing portfolios, making sure that we don't own anything that has tightened too much, making sure that we only own issuers that our credit analysts are really excited about and overweight. And then we're stress testing the portfolio through these kind of events. So we're thinking in a fuel price shock, which industries will be most affected, and we're checking our exposure to those kind of sectors in our portfolio. And then the last thing is we're waiting for risk markets to get really stretched before we actually go out and take risk when we think that we'll be compensated for doing so.
Yeah. So TCorp is an issuer on behalf of the New South Wales government. How do you kind of think about the attractiveness of investing in Australian kind of state governments in this environment where there is more volatility or more geopolitical shocks? How does it affect your thinking on the sector?
I think so far the semi-government sector has held up really well through this period of uncertainty. So spreads are a little bit wider than where they were a month ago, but spreads had also come in a long way over the last year. And so spreads currently are really just back to where they've been on average over the last year. What's impressed us has been the liquidity in the semi-government bonds. So the states have still been able to issue, and they've been able to go about their normal funding business. And we've seen really good liquidity both when we need to buy and when we need to sell. Bid offers haven't widened out. We're still able to transact in really good parcel sizes.
Yeah, I think it's a good segue to bring Dan into the conversation as head of issuance for TCorp. Dan, how are you seeing the current environment, and how does the geopolitical context impact TCorp's issuance strategy?
Yeah, look, that's a multi-layered type of consideration for us, Emily. I think we have a set of parameters around how we execute the funding program. A key part of that is that we do think about our strategy over what we call the forward estimates period, which in government speak is the current year and 3 years forward. So we have an idea of what we would like to do, and that will be informed in part by some calibrations we have around what sort of exposures we're comfortable having, what our maturity profile looks like, and the like. So when we put together these forward plans, part of that, we always have to plan for the known unknowns, so we know stuff is going to happen. There are going to be events, whether they're wars or some other geopolitical event or just something completely left of field. We know they're going to happen, and there's evidence, in previous cycles of these things occurring. So we kind of have to build in a mechanism in our funding plan to be able to, as best we can, manage those risks, because we don't know where they're going to come from. We don't know what form they're going to take. We don't know how long they're going to last. So our issuance strategy will take into account things around how do we allow ourselves to keep borrowing right through the cycle, because the size we are now, we borrow when interest rates are high, we borrow when interest rates are low. So we would describe that as borrowing through the cycle. We can be tactical about how we do that in response to what the market backdrop is. And some of that tactical overlay we put on this will be around things like where there's a lot of volatility, maybe we'll shift our issuance a little shorter down the curve. Client drawdowns, which inform our borrowing. We'd like to generally run well ahead of our client drawdowns, so that when there is volatility like we've seen in the past fortnight, we have the ability to be less active in markets. We can look at different instruments to issue, things like floating rate notes or maybe a labelled ESG bond, as in previous volatile periods have been the sorts of issuance formats that have resonated a little better with investors versus our normal benchmark bond curve. We also have a liquid assets book. We're set up like a bank treasury here. So we have short-term borrowing program, and then we have a large liquid assets book that if we really need to, we've got that to rely on as well to carry us through these periods of volatility.
So you mentioned there that we're issuers through the cycle. How much debt does TCorp need to raise in the current financial year, and how much have we done so far?
So TCorp, for the financial year that we're currently in, that ends on 30 June 2026, is forecast to borrow $21.8 billion from the capital markets. That will be, there's a component of that which is new borrowing and a component which is refining existing borrowing. It's about a 2/3, 1/3 split as things currently stand. So we've funded 17.4 billion of 21.8, which means we're 80% of the way through the program. We've got forecast 4.4 billion remaining, but one of those points I made a moment ago on running ahead of our client requirements is that we're 80% funded for the year, and if you just look at the year over a 12-month period where we are, we're about 67% of the way through the year. So we've got a nice buffer there that allows us to be less active, as you've seen over the last few weeks, when there's been a risk-off environment, or when borrowing costs have spiked, because our borrowers are all fixed rate outright borrowers, so they're very sensitive to outright rates. So that's something that's very front of mind for us.
And maybe just for some context, you mentioned the size of the borrowing program. So how does the current size of the program compare to sort of previous years over the last 5-10 years?
If you look at TCorp going back to about, say, 2010, from 2010 through to 2019-20, we were averaging about $4.5 billion a year. In the early pandemic years, so say 2020 to 2023, we had a couple of years there where we borrowed over $30 billion. But if you look at this year and the forward estimates, we're forecast to average about $23 billion over that period. So you could probably say that from what we were borrowing pre-pandemic on average to post-pandemic on average, it's probably 5 times the size of borrowing in any given year than what we were in the past.
Yeah, no, that certainly explains all the tools you've got in your kit to prepare for market volatility and manage it. And aside from geopolitics, one of the other big themes driving markets is thinking about how high debt levels are for many governments around the world. Fiscal deficits are large and spending pressures aren't going away. So some of those relate to geopolitics and things like defence, but it's certainly made issues about sort of fiscal risk and debt sustainability front of mind for a lot of market participants. So Rachael, I thought I'd ask you first, has sovereign risk and fiscal sustainability become a bigger concern for bond investors recently, like PIMCO?
Yeah, it's definitely something that investors have been worried about for a little while. I think we've really seen it over the last 18 months. I think markets have moved quite dramatically to reprice sovereign risk, so curves are a lot steeper than they used to be. It costs sovereigns more to borrow for longer tenors, and outright yields have moved as well. So I think at this point, a lot of the sovereign risk, we're getting to the point where it is priced in. I also think different sovereigns are in very different stages of this cycle. So if we looked at the UK, they reached the point a couple of years ago where markets did capitulate over their debt trajectory, and they're now getting closer to a period of fiscal consolidation. Then you compare that to the US, they're in quite a different stage of their journey because they're a reserve. There is still a lot of demand for US bonds, and I think that continues for a while. I think for a lot of smaller markets, they still need the US as a place to invest their savings, and there's not necessarily a viable alternative right now. But I think if you look at the amount of debt, if deficits stay at this level forever, then that does become unsustainable, and at some point countries like the US might need to undergo a bit more of a fiscal consolidation as well. In terms of what that looks like, we're not necessarily worried about default risk. We think that there's a lot of household savings in the US as an example, and so as part of fiscal consolidation, maybe taxes need to go higher, and so then you have fiscal sustainability down that method. But it's very different from the starting point that Australia finds itself in, where the fiscal position is very good, and even with that good starting point, the government is still relatively fiscally conservative.
One of the other countries, you mentioned the UK, but there's also been a lot of focus on Japan recently, and sharp rises in bond yields. Do you think that's investors starting to worry about debt and fiscal risks in Japan, or do you think that's part of the broader normalising macro environment and higher interest rates?
Yeah, I think it's a bit of both. Part of it is that Japan is just starting to normalise, having had the cash rate at zero for a very long time effectively. Part of it is also fiscal sustainability. But I do think that the government have some tools at their disposal to mitigate the effects of that. So for instance, if there's less life insurance demand for the very long end of the curve, the Ministry of Finance can skew their issuance shorter, and that's something that they're starting to do already. If people don't necessarily want to buy 30-year bonds anymore or 50-year bonds, then they'll just move the weighted average life of their issuance a bit shorter.
And Dan, what are you hearing from investors? You speak to investors globally when you are there talking to them about sort of the semi-government sector. Are they thinking in line with what Rachael has just said, or are you hearing different perspectives around sovereign risk and fiscal sustainability?
Look, as it relates to New South Wales, just picking up on a point Rachael mentioned about the starting point for Australia as a jurisdiction, when you start comparing it to other jurisdictions around the world, that starting point has actually been quite a big benefit to the semi-government issuers in Australia. For the longest time, the semi-government sector, so I'm sort of going back to now early pandemic, even pre-pandemic, there's always been, Australia's obviously always offered a reasonable level of return in comparison to other jurisdictions. Generally, our natural level of rates is a little higher, and generally our curves are a little steeper. We've got a very good rule of law down here and well-established regulatory bodies. So I think in terms of the foreign investor base becoming more active in semis, it's never really been a question about like creditworthiness, as Rachael mentioned. It's never really been a question about return either. But what has changed from just a few years ago to now is the size of the market here has gotten a lot larger. It's probably tripled in size over the last 5 or 6 years, the semi-government market in Australia. What that means is the liquidity characteristics that are now evidenced, and Rachael also touched upon this in response to the first question around how are they finding conditions, and semis are quite liquid and they've been surprised by the liquidity. That's a really, really powerful characteristic of this market that foreign investors in particular want to see evidence of before they will deploy funds to a market. So if you look at the size of the semi-market now, more borrowing has obviously made the market a lot bigger, but what it's also done, it's grown it to a size that the liquidity characteristics now are becoming more and more appealing to more and more foreign investors. So couple that in with a strong rule of law and attractive returns, you put those sort of three things together, and the proposition for the Aussie semis in particular for foreign investors has been going through quite a dramatic change in just the last 2 years. To give you some examples, when we execute public transactions, we call them syndications. When we do these large public transactions, in the last 6 to 9 months, we've been putting about 35 to 40% of that distribution of those those bond sales have been going to foreign investors. If you looked at like the 5 years before that, it was more like 15 to 20%. So it's a large uplift in foreign investor participation that we're seeing just when we're executing transactions. If you look at just trading that goes on, which we call secondary market trading, where investors just buying and selling through intermediaries on any given day. Again, if you start looking at some numbers there, like over 40% of our secondary market turnover is being done by investors located outside of Australia, whereas in the years before that, you were probably more like around high teens to 20%. So if you just if you think about those two numbers just in isolation for a moment, it's a pretty good endorsement of the semi-government market in Australia as being an attractive destination for foreign investors to participate in, because If it wasn't, they've got a lot of other markets that they can potentially look at. But when you start looking at Australia and you start looking at the return that's available and then the risk, and this is a really important point, the risk that you're actually taking for that return, which we refer to as risk-adjusted return, Australia starts to look very, very competitive against a number of other markets that we are increasingly being compared to as a global investor kind of decides where they want to deploy and how they want to deploy their capital. So it's been the internationalisation of the semi-government market has provided us, it's occurred at a time when semi-governments are on a borrowing trajectory of around $105 to $110 billion a year, every year. Remember that number was about a quarter that size 5 or 6 years ago. But this increasing use of capital markets by the semis is being supported by a growing and a much more diverse foreign investor base than we've ever had in this market.
So Rachael, are they the same factors that would influence your decision about buying state government bonds? Do you think about it in the same way Dan described, or do you have sort of a different criteria that you would apply when thinking about state government bonds compared to federal government bonds or another country's sovereign or corporate bonds?
Yeah, I'd say we think about it in a very similar way. I couldn't agree more with Dan's sentiments that Australia has become a very attractive place to deploy capital. As Dan said, the strong rule of law here, the AAA sovereign rating, the stable government and fiscal outlook, it makes it a very attractive market from a starting point when we're comparing Australia versus, the US or Europe. And then when we're looking at, do we buy a semi or do we buy an Australian government bond or another credit security? What we're really looking at there as a starting point is risk versus return. So as Dan said, is the absolute spread for us attractive relative to where it's been historically? And then also how does that stack up versus other investments that we could put our money into instead? So we look at how the semi-government spreads compare to things like USA-rated corporates. We look at how the semi-government spreads compare to things like Aussie dollar supranationals. But we're not just looking at the spread, we're also looking at the liquidity. And I would say that that's an area where the semis really stand out. They are much more liquid than other global spread product.
Yeah. No, that's very good insights and background. Thank you both. One question, Dan. You talked about the strong demand from offshore investors. Can you just give me a sense of who these investors are and sort of what countries are they coming from that we're seeing such strong demand?
Well, you might not particularly like the answer because it's not going to be very prescriptive, but fortunately for us and maybe unfortunately for the listeners, it's broad-based and it's from a lot of jurisdictions. There's not any one particular type of investor or location of that investor that's driving this. Obviously places like Singapore and London are key hubs, so you can see uplifts in those kinds of jurisdictions. But what I can say, just looking at the last couple of years of data, is the two fastest growing investor types that we've seen buying semis has been official institutions, so things like central banks, reserve managers, and hedge funds. And again, that's not really focused in any one particular place. It's a little sort of geographically dispersed, but really close behind that. There's very little difference in terms of the percentage growth in these investor types from asset managers, insurers, and bank balance sheets. And I'm talking about foreign bank balance sheets, non-ADI type investors has been growing quite quickly as well. And again, it's been from South and North Asia. It's coming from the UK and Europe, but probably if you look at each individual jurisdiction, our fastest growing jurisdiction this year in percentage term change is actually North America. I think in the past, that's been a jurisdiction that semis haven't always had the greatest sort of penetration into the end investors in those locales. But, as we've been talking about here, a lot has changed in the composition of the semi market over the last few years, and perhaps some characteristics of the semi-market, maybe around liquidity, that was holding those investors back in the past, is slowly sort of starting to turn. And some of those investors are now sort of looking at the asset class perhaps alongside Australian government bonds rather than focusing purely on Australian government bonds, because that is historically where the liquidity has been.
Yeah, no, that's interesting that you mentioned North America, because one of the themes out there is this whole idea of de-dollarization. So I actually wanted to ask you, Rachael, whether you're seeing any of this happening in fixed income markets. So the idea that with all the instability coming out from US policy making, are you seeing Australia and other countries benefit from that, or are you not seeing much of a move away from US markets?
Yeah, I'd say with de-dollarization, if I split that into two parts, the US dollar asset selling and then also US dollar hedging, I'd say as a global investor, we're not seeing signs that people are moving away from US dollar assets. I think that it is such a large part of people's portfolios. It has been for a long time, and there's not really a viable alternative at this point in terms of a market that's deep enough and liquid enough to fully replace that holding. I also think as a market, it's still got quite a strong macro backdrop, which is really supportive for people continuing to invest in the US. What I think we are seeing signs of is US dollar hedging. So where parts of the market had historically run lower hedge ratios, like the superannuation sector, we're seeing signs in public data that hedge ratios are increasing there. As far as Australia goes, though, I do think that there is a marginal sort of shift where people are trying to just diversify a little bit more than they used to, where previously people had put 100% of their portfolio into the US. Maybe now they're putting less into the US, and some of the marginal dollars are going into other markets like Australia. I think because the Australian market is still quite small on a global scale, it's only 1.5% of global fixed income outstanding. We are really seeing the impact of those flows. Just a little bit of global money coming into Australia has the capacity to provide a really strong bid for the local market and really overwhelm it. And so that's what I think we're seeing at the moment, a lot of global demand for what's in a relative sense quite a small market.
Yeah. In the LARD podcast, our guest Jared Minack made a similar point where you only need a small amount of money diverted from the huge US market to have a big impact in other markets, and we're seeing that with a huge run up in gold prices as well, which is a much smaller market. I think so far, we've both painted quite a positive story about Australia in terms of our stronger fiscal positions. We are sort of less entangled directly in global conflicts. But Dan, is that saying that the Australian bond market is somewhat immune to these global developments or is benefiting? Is there, any challenges arising for us because of that?
There are, and I think if we use the current backdrop as an example, I guess the two things that really come to mind for us quickly are what do these episodes do? Does it impede or inhibit our access to the market? And then obviously what does it do to borrowing costs? Because at TCorp, when we're borrowing in the capital markets, that cost of funds is being passed through to New South Wales government agencies who are the end borrowers. So when we are looking at markets, about just under 90% of TCorp's cost of funds is comprised from the Commonwealth government borrowing component, or what we refer to as the base rate for TCorp borrowing, and then the spread to own TCorp versus the federal government is added to that base rate, which essentially becomes TCorp's cost of funds. So when we see events like this, we're thinking very carefully about what is happening to TCorp's cost of funds, and then obviously how is that going to impact our clients. We're obviously also thinking about, there are going to be events that happen, and because there are going to be events that happen domestically that can impact our cost of borrowing, but also in a sort of interconnected global rates market, events that happen offshore which maybe have nothing to do with Australia, that can impact TCorp's cost of borrowing in a sense that it could make it more expensive or it could make it less expensive depending on what's going on. So when you think about that number of almost 90% of our borrowing is dependent on federal government, the level the federal government borrows at, and then the federal government base rates are a factor of what's happening domestically, but also what's happening internationally, that international events have a very strong bearing on the rate that TCorp borrows money at, and then obviously where our clients borrow from us at. So we're not by a long shot close to being sort of immune from whatever's going on in the current environment. We're very much directly exposed to it.
So is it fair to say that sort of our longer term borrowing costs are much more driven by offshore developments, but maybe the shorter term ones are more impacted by what the Reserve Bank of Australia does on domestic conditions?
Yeah, that's a fair observation, although, depending on the nature of what's happening offshore, it could have a stronger or a weaker impulse as you move out across our curve.
Yeah. No, it's interesting here having an investor and an issuer because, of course, the higher rates make it more difficult for an issuer and our clients with higher
Rachael
debt
and I
servicing.
want different things.
That's exactly where I was getting at. And, maybe that leads me to my last question for Rachael. We are in a fundamentally different world and a different environment with much higher interest rates now compared to sort of pre-pandemic and before that, after the global financial crisis when rates were near zero. I suppose a broader question, thinking about it from an investment perspective, is, do you think the role of sort of fixed income and bonds has changed in investment portfolios compared to, 10 or 15 years ago now?
Yeah, it's a great question. I think the primary purpose today of fixed income is return. And I do think that current returns are quite attractive, and it's a good time to be an active manager because outright yields are high and curves are still relatively steep, and we've also got a lot of macro volatility and a lot of divergences which give us a lot of opportunity. So if you think about the 10-year Australian bond yield, it's now 5%. You add a semi spread onto that for a 10 to 12-year semi, you're getting nearly 6% for what's a very high quality asset. So I think from a return perspective, fixed income has become very compelling and plays an important role. I think that the big shift has been around diversification, and does fixed income still play a diversification role in portfolios? There's a lot of question marks around whether those correlations have broken down. In 2022 they did, and equities and bonds both performed quite badly. We think that the current environment is a little bit different, and so we still believe in the role of bonds as a diversifier in a traditional portfolio. I think that those correlations only break down when inflation is very, very high. When it's becoming unanchored, that's when bonds tend to perform badly. But in a world where we've only got a temporary supply shock, we think that will abate. Inflation, we think, should only be a little bit above the RBA's target, looking a year or two ahead. And so we still think bonds can play a role as a diversifier as well.
Yeah, that certainly seems to be my impression of the consensus, where people are expecting this to be a fairly short-lived shock, but longer term for inflation to settle back closer to the RBA's target. Well, that's all we have time for this episode of Beyond the Noise. I'd like to thank our guests, Rachael and Daniel, for an insightful discussion. And if this episode was of interest to you, follow TCorp's YouTube channel so you can find out when our next episode comes out. Thanks everyone for listening.